Folks, I'm looking at my YouTube channel. I made a video in the past called Calendar Spread Option Strategy where I talk about calendar spread options. So I got a comment recently from user Varenshaw4997 asking me, hey, is there any way to backtest and simulate such an option strategy? And I said, yes, I can do that. I will post a video soon. So here's that video. Let's get into it. So right now, let's start with a chart. So we're looking at the SPY. So I'm going to devise a calendar spread in the SPY. And why the S&P 500 ETF? Well, as you can see, the Bollinger Bands that I have set here to 2 standard deviations, which is the default. You can see that yesterday and today we made closes above. So yesterday we closed above the 2 standard deviation Bollinger Band, which is a pretty outsized move. And then today we made today we made a move higher. And if you can see though, this candle shows, usually this is kind of a reversal candle. So I think we're going to see a reversal. So one of the reasons why I like to use a calendar spread for reversion trades is most of the time I do not get the timing right. So this buys me some time. In addition to that, calendar spreads will make money on a rise in implied volatility. And if we look today, the VIX, you can see the VIX had a nice little increase today, so we might see some volatility on the horizon. So let's go into my backtesting software and see what type of trade we can devise. Okay, so I'm going to test the SP 500, S&P, SPX, and let's do the QQQs. The QQQs are also above the 2 standard deviation Bollinger Band. So these ETFs don't have earnings, so we don't have to worry about earnings, so we're going to select that. Nothing special. The technical parameter is going to be the Bollinger Band. So Bollinger Band breakout, we're going to select. We're going to say, hey, when the stock is above the upper band, 2 standard deviations, which is the default. So that's it. We're going to set that as the technical parameter. And then let's devise the strategy. So we're going to make a custom strategy. So we're going to add. So I like to do a 30-day calendar where the long side of the options is 30 DTE. The short side is half that, so 2 weeks versus 4 weeks. So 2 weeks is going to be 14 days. 4 weeks is going to be about, let's do 28. DTE calendar. And let's make it 40 delta, okay? So this means we're going to let's do puts. It doesn't really matter. We're going to do 40 delta on the long side, 30 days to expiry, add that. Now let's construct the short side. So a calendar is going to have the same strike, but at a different expiration date. So we're going to select the 14-day expiration date. And then we're going to close all legs with front month options, meaning when the 14-day put expires, the whole trade gets closed out. So we're going to hit save. All right, so we can see that for some reason SPX isn't working. I don't know what the deal is with that. And then the QQQ is a loser, so we're going to just eliminate that. And then let's just have the SPY. Let that run. So on this trade, I have no limits. So let's say if we want to start adding limits, let's say 50% win, and then we could have a 5-day close out after 5 days, and then 100% loss limit, or we'll leave the losses blank and see how that goes. All right, so with a 50% win, that actually and a 5-day closing period, our win ratio is pretty good. However, we cut our return percentage almost in half. Let's do no closing parameters besides closing out that front leg of the option first. So that jumps up to 592% with a 50% win rate. So at the end of the day, it's all about returns, not quite about you want to go after returns, not necessarily how often you win. But again, then you could change this up and make it something like a 20% limit with 6 days and see how that works. You get something like that. Then we can actually change this up and make this, instead of a 40 delta, what would happen if we did a just at the money delta, meaning a 50 a long 50 delta trade that has a 30-day expiry. I know I said 20, let's say 28 days. It doesn't really matter. 30 versus 28, and then 50. So we'll do 14, and let's see how this. So this is basically at the money trade, and basically we're gonna hope that the SPY doesn't move at all. And as you can see, that has even a better trade result with a better win rate. Wow, that's phenomenal. Let's say if we added some parameters, 50% close with 5-day close the trade, and you can see that's a better win rate, but our percent return is lower than before. So very interesting. And this is a 50 delta, so at the money trade. All right, we're looking at the chart again. So one of the main reasons why I like the calendar so much is because when the market is making higher highs like it's been doing the last months, it's just been grinding higher, it tends to continue to grind higher. So it's very rare to be able to catch a large move to the downside. You can back test it. You'll see that if you just buy straight up puts, while the market is ripping, you're most likely going to find a losing strategy. But what's so good about this, like I've said before, it buys you some time. If you go with that 40 delta calendar, you're looking for a little bit more downside action. If you go with the 50 delta, you're basically counting on the stock not going much higher after it's made a pretty good run. So it's going to be, you're planning on some stagnation. Let's go over to Robinhood. Depending on what you want to construct, let's say we go with that at the money trade, which is we're going to buy the 50 delta puts. Okay, this is about 50 delta almost. And then we're going to sell the 14 DT 50 at the money, which is going to be, now we're using slightly different strikes. So we want to look for the 50. Those aren't the best strikes, but let's just say we went with the 690. So you can see this would actually benefit if the stock went up a little bit. And let's just change that to the 685 strike. With the 685 strike now, this is going to benefit if we have some downside move. But either way, if the stock stays stagnant, we're going to make our most money. So the max profit is going to be 438 if we hold volatility at the current level it is now. If volatility really goes up, the front month option will go up a lot in value, and this software can't actually show that. Technically, a calendar spread will always have an undetermined profit and loss, expected profit and loss. This just shows you what the profit and loss is going to be if IV is held constant. And then if we want to go, let's clear these. If we want to look at that 40 delta, how the 40 delta is going to play out, I like to always start with the long option, then do the short option. So let's find 40 delta slightly out of the money. So, okay, 684. 683 is closer to 40 delta. So we're going to start with that, and we don't want to sell it, we want to buy it. So we're going to purchase that, and then we're going to sell the shorter dated 14-day to expiry option. So 33 versus, so this is 43. So that's, again, these options aren't the best because they go up and down by increments of 5 rather than 1. So here is our almost 40 delta option. So again, if there's a little bit slight move to the downside, but if it stays basically where it is where max profit's going to be. So max profit's going to be $400 plus. And then again with these things, you can be wrong if it continues to move to the upside. If it goes up another 1.5%, you can still make money on this thing. So we're just betting. We're betting that maybe there's some downside movement. We're betting that there's not going to be much more upside movement in the short term, and we think that the stock is going to relatively stay where it is and maybe even go down a little bit. So that's kind of the thought process behind this trade.